The stock market is currently closed as of Sunday, January 25, 2026 at 10:31 p.m. EST. Micron Technology (MU) concluded the last trading session on Friday, January 23, 2026, at an official closing price of $399.65. This price represents a significant intraday climb, during which the stock reached a 52-week and all-time high of $412.43 before paring some gains toward the bell. While the headline figure shows a half percentage point rise on the day, the underlying data reveals a much more aggressive positioning by institutional desks. On January 23rd, the stock saw a massive volume spike of over 35 million shares, significantly higher than its 30-day average. This indicates that despite the broader semiconductor sector feeling some fatigue, high-conviction buyers are stepping in to accumulate shares even at these record valuations. A surprising insight that most retail investors are missing right now is the sheer intensity of the silent, multi-year contract negotiations. While the public focus is on quarterly earnings, Micron is currently quietly finalizing agreements that lock in pricing and volume for its entire high-bandwidth memory supply through the end of 2027. This effectively removes the cyclical risk that has haunted this stock for decades. Usually, memory prices are volatile and spot market dependent, but Micron has moved toward a utility-like revenue model for its most profitable chips. This is fundamentally changing how Wall Street analysts calculate the terminal value of the company. The common market belief is that Micron is just a beta play on the artificial intelligence hardware boom, essentially a second-tier beneficiary to the dominant GPU manufacturers. Many investors assume that because the stock has risen over 260% in the last year, it must be nearing a cyclical peak. There is a persistent fear that memory supply will eventually catch up to demand, leading to the same kind of brutal price crash we saw in 2018 and 2021. This narrative suggests that the easy gains have been made and that the current $400 billion market cap is unsustainable for a company in a traditionally low-margin industry. However, a deeper look at institutional positioning and supply constraints challenges this skeptical view. Unlike previous cycles, the transition to high-bandwidth memory, HBM, is consuming roughly 3 times the wafer capacity of standard DDR5 memory to produce the same number of bits. This means that even if manufacturers increase their capital expenditure, the actual output of usable memory bits is growing much slower than in the past. Micron's recent decision to buy a Taiwanese chip fab for $1.8 billion to rapidly expand capacity is a defensive and offensive masterstroke that the market is only starting to price in. We are seeing a structural shift where memory is no longer a commodity, but a specialized bottleneck. Institutional buying behavior has been notably aggressive in the first weeks of 2026. Data from recent filings suggests that several large hedge funds have transitioned from being neutral to overweight on Micron, specifically citing the expansion of gross margins from 57% toward a projected 68% in the coming quarter. This type of margin profile is usually reserved for software companies, not hardware manufacturers. The volume patterns on January 23rd showed several large block trades occurring above the $400 level, suggesting that big money is not afraid of the current price tag. Short interest in Micron is also an area that requires careful interpretation. Currently, there are roughly 30 million shares held short, representing about 2.7% of the float. While this is not high enough to trigger a massive viral short squeeze in the traditional sense, the short interest grew by nearly 20% in the last reported month. This indicates that a significant group of traders is betting on a double top or a macro-driven correction in tech. These short positions are likely held by macro funds hedging their long semiconductor bets, or by mean reversion traders who believe the stock has extended too far from its 200-day moving average, which currently sits near 193. The short thesis centers on the idea that consumer electronics, such as smartphones and PCs, are still relatively weak, and that if AI data center spending slows even slightly, Micron will be left with excess capacity. Counterarguments to this emphasize that even as smartphone units decline, the memory content per device is increasing by 20% to 50% to handle on-device AI features. Retail investors should monitor the borrow rate closely. While it remains low at around 0.25%, any sudden spike would indicate that shares are becoming harder to find for short sellers, which could precede a quick leg up in price if those shorts are forced to cover. You can find this data on platforms like Fintel or through the short interest reports published by the Nasdaq every 2 weeks.
Comment how many shares you currently hold and if you are concerned about the current short interest growth. I want to see if the sentiment here matches what we are seeing on the institutional side, or if there is a growing disconnect. Retail sentiment on platforms like Reddit and X is reaching a fever pitch. Discussions are no longer about whether Micron will survive the cycle, but whether it will reach $1,000 by 2027. While some posters are rightfully cautious about the cycle-ending nature of AI, the majority are focused on the unprecedented DRAM shortage reported by Micron's executive team. There is a lot of talk about diamond handing through the volatility, though retail investors should be aware that they lack the tools to influence a stock with a $450 billion market cap. The movement here is almost entirely driven by institutional rebalancing and global supply chain data. Briefly, for those new to the ticker, Micron is the only US-based manufacturer of DRAM and a global leader in NAND flash memory. Their business model involves taking raw silicon and creating the high-speed memory modules that allow processors to function. Historically, they were a boom and bust company, but they have spent the last decade diversifying into automotive, industrial, and high-end data center markets. Their past performance was marked by extreme volatility, but their fiscal first quarter 2026 results showed record revenues of $13.6 billion, proving they have entered a new phase of scale. Looking forward, there are multiple scenarios. In the bullish case, Micron's HBM4 development, which is currently being sampled to major partners, delivers the 11 gigabits per second speeds promised, allowing them to capture more market share from competitors like SK Hynix. This would likely push the stock toward the $550 to $600 range by the end of the year. In the bearish case, a broader macro slowdown or a sudden shift in AI architecture that requires less memory could lead to a sharp correction back toward the 300 level. The key catalyst to watch will be the second quarter fiscal 2026 earnings report, where the market will look for a beat and raise on those 68% gross margin projections. To summarize, expectations for Micron were originally rooted in its history as a cyclical memory maker, but the reality of 2026 is that it has become a high-margin AI infrastructure play. The divergence between the cyclical peak fear and the structural shortage reality is where the opportunity lies. While the short sellers are increasing their bets, the institutional volume at all-time highs suggests the path of least resistance remains upward. Investors must weigh the risk of a high beta tech correction against the undeniable reality of a fully booked order book for the next 24 months. Would you like me to analyze the short interest trends and institutional ownership changes for SK Hynix to see how they compare to Micron's current momentum?